How's it going, everybody? It is Dennis, and we're back with another video this week. And this week, we are continuing the topic on YieldMax ETFs and trying to educate more people. If you're new, or if you're, maybe you've had these ETFs, or if you've dabbled in these ETFs, and you just wanted to have a better idea of these ETFs and how they work and what they are and when to buy them, which is what we're talking about. Or actually, we're not. We talked about when to buy these ETFs. We've already done a video on that. So if you haven't watched that already, watch that after this video, because this video is going to help you decide which ETF to choose, right? We see it on the title. Which YieldMax ETFs should you buy? Which is the best for your portfolio, for your risk tolerance, and for your overall return and what you want to get from these YieldMax ETFs. Of course, if you haven't watched or you don't even know what YieldMax ETFs are, we'll go over it really quick in the beginning of this video. But if you want a deeper dive into what these YieldMax ETFs are, there's many channels that go over it. I have a video from a year ago where I go over what these YieldMax ETFs are. So if you need a deeper dive into what these funds are, there's videos on that all over YouTube, including on my own channel. But today we're going over which YieldMax ETFs should you buy, which one should you hold, and how do you choose them? Is it by the yield that they provide to you? Is it by the payment method? Is it a monthly payment? Is it a weekly payment? Which time do you want to receive the payment? Do you want on the first week of the month, second, third, or fourth week of the month? This is all things you can take into consideration when you go ahead and do research in these funds. So we're going to go over the basics. I'm not going to tell you which ones to choose. This is not a stock pick or an ETF pick video. This is just information based on how I look at these ETFs, how I choose my ETFs, and this is, I believe, how many people should do their research before they even go into these ETFs and buy one. All right? So let's go ahead and get started. If you do not know, of course, what these funds are and how they make their income, YieldMax is pretty clear. If you go on their website and do some basic research, you can see that they run synthetic option calls, or they have a synthetic position in their underlying stock. So say we have TSLY. TSLY is one of their ETFs that they have. It's a single stock ETF that pays monthly. They hold the underlying of Tesla, right? They do not hold shares like something like FEPI does. FEPI is an ETF that also pays monthly, and they pay around 25%, but they hold actual shares in which they run a covered call strategy on. YieldMax, it's different. They have a synthetic position, which they sell a short put, and then they buy a long call, obviously long for purchase, and then short for sell, right? So they have a short put, a long call, which creates that synthetic position. It's pretty much like owning 100 shares of a stock, but you don't. It's just options, so it's a little bit cheaper as well. They're able to leverage their money a little bit farther than if you were just to purchase shares. They also have short calls, which is selling a call, and they sell that call on that fake position. I call it a fake position. That's just how the way I go. So if you hear fake position, that is what I mean throughout the video. So fake position is what I call synthetics. So it's a fake position. It's a fake 100 shares that they don't actually hold. They just have the contract to possibly hold it at the end of expiration, which they never end up having, right? So they have that fake position. On that fake position, they create cash or income by selling contracts on top of it. So they sell short calls. Usually their strategy, what I've heard at least, is to be around the 5% mark away from what the price of the stock is trading at currently every single week, and they stay around the 5% mark to try and make as much income as they can from the volatility of the stock. So Tesla has volatility, say, of 50%. They want to get you that 50% income on an annual basis based on that volatility. Of course, as volatility fluctuates, so does the income that they make for these funds. So it could be 80%, it could be 50%, it could be 20%, depending what the funds you are in and depending on the underlying volatility. So that's how they make their money. That's how they trade. They don't hold the stock itself. That's the main thing. They don't hold the stock. So you do have limited growth due to the covered call strategy on the top side. You are limited, but with their new ability to trade, their new prospectus, they're able now to buy calls on top of their short calls to gain more of that upside if they decide to do so and they see there's a potential to do so. So there is that now as well. So you are able to gain some better gains, I guess, in a way than previously they did for the year previous to this, or previous to this year, right? So in the 2023, when they were trading, they were a little bit lacking on the upside side of their trades, so they weren't able to capture due to the covered call they were selling. But now they have the long call, which they're able to gain some of the upside. So Tesla went up 20%, they could gain around 15%. So it's not one-to-one, but they're able to get some of that upside as well as provide you income on top of that. So That is the basics of these ETFs. Like I said, just go, if you don't know what YieldMax ETFs are, there you go. You know the little bit of it. If you want a little bit more in-depth video or a deeper video, there's videos for that online. But as always, I like being transparent as possible, and I will not be making a video if I personally did not own these ETFs. And I own a lot of these ETFs. These are my positions in YieldMax ETFs. I have AMZY, AMZY, GUI, YMAX, TSLY, and AMZY, which is my new position. In AMZY, I have 271 shares. AMZY, I have 303 shares. GUI, I have 325 shares. YMAX, I have 455 shares. TSLY, I have 433 shares. And AMZY, I have 180 shares, which once again is my new position. And like I said, I love being transparent as possible. And with my transparency comes the negatives as well. So as you can see currently, all the positions are negative. Of course, this is a little bit biased because we did have a little bit of a market crash or a market downturn. The S&P, after our little Fed meeting, did decide to go down, and the whole overall market decided to go down by roughly 3 to 2.5% or basis points, so however you determine it. But yet the market did go down, so did all the funds that we own. So yes, these negatives look pretty bad, but don't worry, they were actually in a pretty good position. AMZY was in the green, AMZY was in the green, and TSLY was trending up towards the green as well, with Tesla the underlying. So it was going quite well until this week when we had the Fed meeting. But what can you do? All that matters though, we're still making our dividend income. And of course, right here, we have our YMAX position, which is one of my largest positions now when it comes to cost basis in my portfolio. So the portfolio diversity in YMAX currently is 10.59%, one of my largest YieldMax and overall dividend holdings in my whole portfolio. So 10.59%. I have roughly 7,961, so pretty much $8,000 invested into YMAX alone, which is their weekly paying ETF, which we'll get into right after this. And that's again the 455 shares, and I'm down currently, where is it, right here, negative $765. But of course, like I said, this is due to the downturn of the market recently this week, so there is that bias to be considered. Now, weeklies or monthlies, this is an important decision you should do. This chart right here, this is the old chart, this is the new chart, but I like the old chart better because it demonstrates a little bit better of when you receive your payments, what dividends are paid out when, and which ETF pay out when, so you can better decide what you want to own. This one is just a big list of the payments you'll be receiving for 2025, but this is a little bit, like I said, more detailed. So there's weekly pairs. The weekly pairs are YMAX and YMAG. YMAX has all the YieldMax funds. Of course, some of them they're not adding, such as, I'm pretty sure the new funds that came out, they're not adding into YMAX. I forgot the names, not going to mention them. They're brand new, so not much to that. But YMAX and YMAG are the weekly pairs now. They pay every single week. YMAX, like I said, has all the different ETFs that YieldMax has to offer. It's just a big pile of all their funds, and they take those distributions and they pay out to you in YMAX every single week. And then we have YMAG, which is of course the MAG, the Magnificent Seven. Those are the magnificent. I can't say it. Magnificent. Okay, you get it. The Mag 7 is what is in YMAG. So those are those payouts. So let's say you have TSLY, GUI, MSFO, AMZY, AMZY, and there's one more, I think, right? I missed one. I know I missed one. But there's the 7 payers for the Mags. I'm just gonna say Mag 7 for the Mag 7, and those will pay you out every single week. So you get to choose whatever you want. Do you want to invest into like technically the S&P or the overall market? You go into YMAX. You want to invest into Mag 7, then you go into YMAG, right? Pretty simple. Then we have the monthlies. We have Group A, Group B, Group C, and Group D, right? Group A, Group B, Group C, Group D. Group A, we have TSLY, Crash, GUI, YBIT, OARC, Zomo, Snowy, and TSLY. With Group B, we have NVDY, DIPS, Phoebe, GDXY, Babo, GPMO, MRNY, and PLTY or Palantir, right? And then we have Group C, we have CONY, Fiat, MSFO, AMD, Nefly, ABNY, PP, and ULTI. Group D, we have MSTY, YQQ, AMZY, AMPLY, AIYY, DISO, SQY, MSTY, SMCY. So there's a lot of funds, a lot of different underlyings that they trade, a lot of things that go on with these funds, and they continue to add more and more and more as time goes on. So these groups will expand and grow larger, and you'll have more options to choose from depending on which ETFs you want. But overall, why are we looking at this? Well, do you want weekly payments? and of course they're going to be a little bit smaller, then you go for YMAX and YMAG. And also it offers you a little bit of diversification and safety. Of course, they're not the safest compared to something like FEPI or even JEPQ or just a basic dividend aristocrat or a pair that you see like Coca-Cola, right? It's not that, but you do get weekly pairs. Every single week you get a payment depending on the distributions that YieldMax ETF offers. That's what you're going to receive, right? YMAX, YMAG, whatever you own, you're going to be getting distributions every single week depending on what is paid from the single stock holding ETFs. Now, you could also have weekly payers by holding one of these funds from every single week. You have a Group A fund, a Group B fund, a Group C, and a Group D fund. You will get a payment every single week, but technically those funds will be paying monthly, right? So they're monthly payers, they're monthly paying ETFs. The single stock are monthly paying ETFs, but they will be technically paying every single week if you hold all the different groups. Now, if you don't want to hold all the different groups and you just want to choose one fund, or you just have enough income or enough cash on the side to just choose one fund, then you'll be receiving, of course, one monthly payment, right? So that's what you have to choose. All right, this, you guys could take a pause. If you guys want to pause the video, I'll move to the side. You guys could pause, zoom in, and see all the distributions. Of course, this is on their Twitter page as well as their YieldMax official page. So if you want to look more into it, deeper into it on their distribution dates and how they work and function, you could go ahead and pause, zoom in, or go on their website, of course. But yeah, so they have weekly or monthly pairs. Now, what do weeklies offers? Well, obviously with YMAX, we have a 34.91% payment. This one, as I mentioned before, fluctuates a good amount. So currently it stands at 34.91%. We have YMAG, which if I move over to here, has 43.01% currently distribution annually. And of course, we have the dividends that they pay as well. So we take a look at YMAX distributions right here. You guys can go ahead and follow me. I'm not going to point at it because I'm going to block a lot of it probably. But currently, we have payments around the average of 20 cents per week. That's what you can expect from both of these funds of YMAX and YMAG. Sometimes YMAX outperforms with the recent payment in November 29th or the last week of November where they paid 30 cents, right? Or we could look at another payment of 24 cents or 22 cents, or sometimes they might pay 1, 2, 3 cents, right? In December, I'm pretty sure, I don't know if that's accurate or not because it's not filled out. But let's go look at November, right? The first week of November, they paid 12 cents. So it fluctuates. It depends on how much they're able to earn. And so does with YMAG, right? YMAG, if we look down here, they have payments of 20 cents. They have payments of 28 cents. But then they also have payments of, where is it? 5 cents, right? They have payments. Where's the other one? There should be another one, 6 cents, right? They have a 6 cents and they have a 5 cents payment. And the reason for that is because sometimes it's one of the groups, which because it's, you know, it's 7 funds and you can't split 7 evenly out to 4 groups. You would need 8 funds for that. So one of the funds is left on its own in one of the weeks. And that is, unfortunately, I'm pretty sure if I'm not wrong, MSFO, or the underlying Microsoft, which has a low volatility and therefore causes you to have 1 week of every single month where you unfortunately get a low payment in YMAG. So that is the distributions. Once again, if you want to pause and zoom in and look at them, they're also offered on their website. So if you want to take a closer look as well, you could go on the website. But that is the weekly pairs, YMAX and YMAG. That is their distributions estimates when it comes to the annual payments. Of course, they fluctuate and they change every single week and month. So I wouldn't look too closely into those. I would just take the average that you see from the past yearly payment or the year-to-date payment and go based off of that. So let's go ahead and move into the monthlies, or aka the single stock ETFs, right? So these are some of the 6 that a lot of people are familiar with, and therefore also the ones I kind of enjoy. A couple here that I'm not a fan of. We're not going to get into that too much. We have TSLY, we have NVDY, we have AMZY, CONY, MSTY, and then we have Crash. I'm pretty sure this is Crash. Yep, it's Crash. That's the actually reverse of TSLY. So it's I always forget what it's called. I don't know why I always forget what it's called. But instead of trading calls and being bullish on Tesla, they are bearish on Tesla, and therefore they trade against Tesla. So if Tesla goes down, Crash goes up in value, and yeah, it just goes up in value. They seem to be earning a decent amount of dividends distribution. As you can see, 113% annual return compared to TSLY's 88.37%. But unfortunately, their value has dropped recently a lot, especially with Tesla's growth. So like I said, they do offer a lot of different funds. So if you want to go something against a specific stock with earn dividends while you're waiting for that stock to go down, look at Crash, look at Fiat. Fiat is against CONY. It's a position that's against CONY, or pretty much Bitcoin if you want to think about it that way. Or Coinbase, sorry, it's against Coinbase, the underlying, but it's against CONY as well, and it's like a hit going against Bitcoin because Coinbase is correlating with Bitcoin, just to clarify it a little bit better. But my favorites from these are TSLY and AMZY. These are the two positions, like I mentioned before, I hold. MSTY is the one I'm not a fan of. CONY is the one I'm okay with. I've held CONY before, but I've sold out of it. I don't hold it anymore. Crash, I wouldn't hold because I'm always bullish on the stock market. Just because, I don't know, you never bet against the market. It always goes up. It's just how it works. You never bet against it. And NVDY is a pretty good hold as well. It's provided a lot of distributions and a lot of benefit for a lot of its holders. And it's actually one of their biggest funds, I'm pretty sure. Yeah, I'm pretty sure it is. It's one of their biggest funds. It's done well with NVIDIA going up. It's paid some good distributions. It's been slowing down a little bit, but it's to be it's understandable with NVIDIA slow down as well and volatility dropping a little bit around NVIDIA. But yeah, these are some of the funds they offer. With those funds, of course, we have the underlyings, right? So with TSLY, of course, the Tesla stock, or Tesla is the underlying. With AMZY right here, Amazon's the underlying. With NVIDIA is the underlying. And with CONY, Coinbase is the underlying, right? All these single stock ETFs, or single underlying stock ETFs, like TSLY, AMZY, they hold just one stock. They hold that one stock, they trade on it, they make their income off the volatility of their stocks, which is usually higher than YMAX and YMAG because they're diversified and safer. I say safer because it's not that safe, but it's safer than holding a single stock ETF, obviously. So you're able to capture the volatility of that single stock. Tesla has a good volatility. You're going to get most of that benefits of that strong volatility. NVIDIA had that strong volatility when it was going up. You're going to get the benefit of that strong volatility. Coinbase has a strong volatility because Bitcoin's going up. You're going to get that benefit of that high volatility. Now, how do they compare to their underlying? A lot of people on social media, a lot of people on YouTube and Twitter are saying, what's the point of owning these funds if they just underperform their underlyings? Well, they're for income. If you want income, you're going to own these stocks. If you're either retiring or you just want to have income on the side, depending no matter what your age or your retirement status, you just want to have income on the side, you want to earn extra income, these are some good funds to own. Of course, they'll offer you high yields. You know, it's called YieldMax ETFs. They'll offer you some high yields. Now, there is some strategies you could run on them. I'm not going to get into the strategies in this video. That was mentioned in the previous video of when to buy and also how to run a small strategy on buying and reinvesting, but that's a different topic, a different video. But overall, if you look at the underlyings, looking at TSLY and Tesla, if you zoom in, if it's not clear on the screen, looking at TSLY and Tesla, TSLY year to date or on the 1 year chart has performed at 38.48%. That is overall performance, so reinvesting your dividends. It is at 38.48%. With Tesla, it's at 74.6%. So you are lacking behind around your 2 times less return than if you were to have on Tesla. But if you notice, that is towards the end of the chart. If we look at this end part of the chart where Tesla, of course, had its run and is currently having its run due to its, just overall Trump's and Elon's connections together, or whatever you want to say. But Tesla was having its run up and is currently having its run up. And that is where Tesla, like I mentioned before, and with most of these single stock ETFs, is not able to capture all of that growth. But if we look down the chart, a little bit left of the chart, we can see that TSLY actually outperformed Tesla. TSLY was outperforming Tesla by around, I don't know, what is that? I would say 2 to 5%, maybe 2 to 5% on between these two, the blue and the orange line. We can see, so it was outperforming Tesla around the May and February time, or from February to May and early into August. It was outperforming Tesla, but as soon as Tesla started having its run, it no longer was outperforming Tesla because, of course, it's not able to capture all of that growth. Looking at AMZY and Amazon, same story. AMZY was outperforming Amazon through May to early August. It was doing quite well from August to like September-ish, right? It was outperforming. And then what happens? Once we get down the line over here, we could see that Amazon starts outperforming AMZY. If we look at the numbers, Amazon is currently at 43.13% growth for the year, and AMZY is at 35.35%. Now, that's a little bit closer, right? With TSLY and Tesla, it was a 2 times difference. With Amazon and AMZY, that's pretty close. That's only That's not even a 10% difference. That's 8-7% difference. That's pretty damn good, especially with the fact that you're getting dividends, which increase your share count, and with increase of your share count, then you get more and more and higher dividends, assuming that the dividend distribution stays the same, right? If we look at NVIDIA and NVIDY, right, we can see that in the beginning they were quite close. There was moments where they did get quite close to each other when it came to performance. Of course, NVIDIA did hold its own, and for the whole year, since they did have growth the whole year, it had growth. NVIDIA was just not able to capture that. But even with the ability not to capture it, it still performed quite well, getting 108.09% per return for the year with dividends reinvested compared to NVIDIA's 157.50% return. So what is that? That's 50% worse, right? Or yeah, it's 50% worse, or technically 50% better on NVIDIA's side than NVIDIA. And you're also growing your share count, like I mentioned before, with NVIDIA, which then when you want to take out income, you can take out income whenever you want. So the performance to the underlying, of course, is not the same. There's some underlyings which just outperformed on the ETFs, the YieldMax ETFs completely, like TSLY and TSLY, because they're just not able to capture all that upside if you have a crazy amount of growth. But in general, these funds are trending upwards with their overall return, including dividends reinvested. Now, once again, the dividends reinvested strategy is something for a different video and for a different time. Whatever strategy you decide to run and how you use these dividends, that's up to you. But in general, with dividends reinvested, they perform quite well, even outpacing the market. TSLY, 38.48%, that outpaces the market. AMZY, 35.35%, that is outpacing the market, or the S&P 500 is what I'm mentioning when it comes to the market. 108%, better than the S&P 500. If you look at CONY over here at 50.38% return, better than the S&P 500. 82.40% from Coinbase, of course, is definitely way better than the market, but look at that again. If you look at the chart, they get quite close to performance-wise, and they only start losing once we get the huge growth from the underlying. So, as you can see, these ETFs are not bad for performance and for growth over time. They are possible to have growth if you are reinvesting the dividends. Of course, how much you want to reinvest is up to you. Do you want to have 25% reinvested, 50%, 100% reinvested? That's all up to you, and how much income you want to earn and hold on to, and how much shares you want to increase and have growth over time. It's all up to you. It's whatever you decide to do. But in general, they have all outperformed the S&P 500 this year. All of them have outperformed the S&P 500 this year. So that's something. That's something to show right there. But moving on with the dividends, right? What kind of dividends are you going to be receiving? So we looked at weeklies and monthlies. So we looked at the differences. Of course, one pays weekly, one pays monthly. We've looked at how you can use monthlies to receive weekly dividends. And we've looked at maybe you don't have enough to purchase all those funds, so you just purchase one fund and you get a monthly payment. We've looked at the underlying. We've looked at how they perform compared to the S&P and how they perform to their underlyings, right? How the ETFs were performed, and are they lacking? Are they ahead? At what times are they lacking? At what times they're ahead? We've looked over all that. Now, the most important part is how much are you going to get paid? This is another important part. When you're choosing an ETF, you have to choose an underlying that you trust for long term, you are bullish on, and in general, you would hold it. If it wasn't paying you a dividend, you would hold that underlying. So you need to choose that, right? You need to choose that correctly. And you also need to choose how much dividends you want to receive, because that's another important part depending on what you're using these funds for, right? If you're using these funds for daily expenses or bills you have to pay, you want a high yield, so then you could afford it for a cheaper entry, right? You put 1,000 in, you want 100% return. So you go ahead and go for something that has 100% return that's able to pay you $1,000 back, assuming no NAV erosion in a year, right? And we have an ETF like that, like CONY, which currently is offering 109% annual return. So $1,000 put in will get you $1,009, right? If I'm not wrong, or $1,090, sorry. $1,090 is, I think, is the correct calculation for that. $1,090 is how much you would receive if you were to go into CONY and it stayed at this rate and the NAV didn't erode. That's how much you would get. You would get $1,090 at the end of the year, right? Then we have ones that have 67.75%, 74.36%, and 88.37%, right? So you have to choose which one you want. And if you look at the dividend payments, we look at TSLY, we have payments around the $1 mark, the 80-cent mark, the 60-cent mark. Like I said, it fluctuates depending on the volatility of the ETF and how well they're able to do trades. With Amazon or AMZY, we could see payments of 40 cents, 50 cents, 90 cents for 2 payments in a row. We have 70 cents, 60 cents, and $1.17 from the last dividend in November. We then have over here, I'm looking at the wrong side. We have over here NVDY, which paid $1, $2, another $2 2 months in a row, and more dollar payments per month, right? And then we have CONY, which paid us $2. Where I think it has a $3 one. It doesn't have a $3 one, but we got close at $2.79, and just in general, $1 and over dividend distributions per share. So it's for you to decide what you want, and that's why we end with this last slide for the video. It's what do you want from these ETFs? Like I said, this is not a video for me to tell you which ETFs to choose. It's something you have to research and decide, but this video is just to make you understand of what you need to look for. You need to look at the percentage annual return, right? Don't do that by just going on the website and going, ooh, 100%, ooh, 40%, ooh, 30%. No. Don't do that. Look at the charts. Look at the past dividend payments. Is it stable? Is the volatility on their underlying stable? If you go on, I think it's called a chameleon volatility or something like that. There's a website where you can look at volatility averages and look at the graph of volatility for the year on the underlying. So go on TSLY, search up the volatility of it. If you see that it's staying around the 50% mark, assume you'll get around 50% annual distribution on your TSLY position. Meaning $1,000 in will get you $500, assuming no NAV erosion, right? If you look at NVIDIA, if NVIDIA has 80% volatility average, then you go ahead and go for NVIDIA. Now, if you see a stock that has a spike up to like 100% volatility rate, but then previously it was at 30 or 40, expect that volatility that could go down. That volatility could go down, and your 100% annual return might go down to 30 and 40%. You have to think about all those things. Before you even choose them based on how much they pay you annually, you have to look at the underlyings. Is the underlying a good position? Will I hold, like mentioned before, will I hold this underlying? Even if it didn't pay me a dividend, will I still hold this underlying, right? Would I still hold Tesla? Would I still hold Amazon? Would I still hold Coinbase if it didn't pay me a dividend over 1, 2, 3, 4, 5 year basis, right? The benefit of this is you're getting dividends. So you're getting something in return, even by just holding. If it's going down, you're still going to get dividends. If it's going up, you're getting dividends. It doesn't matter, right? So you just need to decide, are you bullish on the stock? If you're not bullish on the stock, then go look for a reverse fund, right? Go for fiat, go for crash. If you're against Tesla, go for crash. If you're against Coinbase and Bitcoin, go for fiat, right? They have reverse funds as well. But if you're bullish on a stock, choose that stock. If you're willing, like I said, to hold it for years and years on end, choose the stock that you're willing to hold for years on years on end. If you see red days, it won't bother you because overall you're bullish on the underlying, and therefore you will be bullish on the ETF, especially since it's paying you monthly if it's a single stock ETF. And even better, doing the monthly and weekly choice again, with weeklies, you're getting weekly payments, and with that weekly compounding, assuming you're reinvesting. Also, you're diversified. It's safer. Once again, not that safe compared to JEPQ and FEPI and RITM and all these different funds that are a lot safer, or the dividend aristocrats or the Coca-Cola or the Intel, right? It's not as safe as that, but it's safer than holding a single stock ETF. And if you choose YMAX, you might get a lower payment of 30 and 40%, but you'll have diversification, right? You'll have MSTY in that fund. You'll have APLY, NVDY, GUI. All these different funds will be in that one fund, like YMAX, or maybe you like the Magnificent 7 or the Mag 7, and you want to have a diversification in those funds. You choose that fund of YMAG, and you receive the weekly payments, and you get that compounding effect, and you just feel better because you're getting weekly payments. It's like a paycheck every single week, right? Instead of having to wait a month for every single payment, assuming you only have one single stock ETF, and you're like, oh, now I have to work out how much income I'm able to spend every single week from this one monthly huge lump of cash, right? So it's all up to you. This is what this video is about. It's just a basic overview of how you should be looking at these ETFs when you're choosing them. When you're buying them, there's a video for that. I made a video about when to buy in and how to decide when to buy in if you've chosen which underlying you like. That's a different video. You can watch that after this. But when you're choosing it, initially, you go on the website, you see the list, you have to follow those basic ideas of, am I bullish? Am I against this fund? I mean, am I against this underlying? Am I bullish on this underlying? Do I see a future in this in 5 years? Would I hold this for 5 or more years? Am I okay with the distribution it gets? What's my reason for investing in these funds? Is it for retirement? So I want high income. How much income do I want? Do I want 30% income, 40% income from how much I have invested, or do I want 100% income, right? You have to understand what you're going into these funds for before you even go into them. So don't go into them and end up on Reddit or Twitter and going, oh my God, I hate these funds. The distributions went down, the NAV went down. I'm not going to hold these anymore. I'm having red days. The people who end up like that, they just bought in because they saw a big number. They saw a big number on distributions. They saw people post on Twitter, on YouTube, on Reddit, how much they're making. And then when they don't end up making that much because they don't understand the basics of these funds and the volatility aspect and how volatility goes up and down, because that's what volatility is. And they choose an ETF which underlying has high volatility for a couple months, but then crashes back down. And now they're sitting there holding a fund that was 100% distribution, but now it's 50%. And you just half the amount of income you have, and you just experience NAV erosion probably as well. So that half now goes to 25%, depending on your average cost into the shares. So once again, just the basics of how you should look in these funds. I hope you guys enjoyed this video. Hope you guys learned something. This is how I choose my funds. This is how I chose AMD. That's how I chose TSLY and AMD and APLY and AMZY and GUI. I chose these funds not because they paid crazy amounts. APLY and GUI don't pay crazy amounts. But the reason I chose them is because I would hold them. I would hold the underlying for 5-10 years. And just getting that dividend is a benefit. Sure, it underperforms the underlying at some points, but I get the benefit of getting a dividend and being able to do whatever I want with it. Either be reinvest back into the fund, reinvest into my option strategies, or take that cash and use it for my daily expenses if I want to. That is why I choose the funds I choose. That is how I view these funds. That's how I do the research for these funds. Don't go into these funds just because of big numbers and 100% return. Do not do your research. Look at the underlying. Would you hold them? Just be a smart investor. All right. So thank you so much, everybody, for watching. Thank you for looking at my presentation and my hopefully a good video, decent video, long video. I'm assuming, how long have we been doing this? It's already been 30 minutes-ish. So thank you again for watching. Hope you guys enjoyed. I will see you guys next week going over how much we've made for December. Actually, no. Yeah, it'll be next week. Next week, we're going to see how much we made for December. See you guys next week for that video. And thank you so much again for watching. Hopefully you guys stay as smart investors and decide wisely which funds you want to go into, if you even want to go into these funds after doing your own research. So see you guys later. And I hope you guys like, subscribe, and thank you so much for watching. That has been me, Dennis.